We've seen quite a tremendous rally since the Fed decided to hike rates, and it continues. And those two things in a normal environment, if you're looking at things in a textbook, typically wouldn't make a whole lot of sense. You wouldn't expect the Fed to raise rates and the stock market to rally. You would expect the Fed to raise rates and the stock market to fall. However, the stock market did fall in anticipation of rates rising. And like we see with random events, when there's rumors and speculation that it's going to occur, we typically see the move going into the event and then the opposite of what's expected occurring after, because so many people have been banking on that, expecting that everyone who wanted to benefit from it got in ahead, and then the event comes and there's nobody else to partake, and everyone is just trying to profit take at that point. I think we had a little bit of a similar dynamic here. I think the market got very anticipatory of rates rising. It wasn't a shock to anybody. Everyone knew exactly what the Fed was going to do, but they were concerned about it. So they positioned accordingly, anticipating rates to rise, and then rates rose and the market rallied. They had to refill their positioning. They were way out of balance. They saw it, oh, wow, nobody's aggressively selling this right now. Nobody was shocked by it. Nobody was anticipating a different outcome. And there was a little bit of a vacuum. So I think this rally, while I like it, and I'm participating in it, and I'm not betting against it, I think it is a little bit of a vacuum rally. I think it has gone a little too far too quick. Who knows? We'll see what the market decides to price. These guys over here talking about international buyers coming in. I guess that makes a lot of sense with the geopolitical tension, but that's just technical cash. Over here, what are we focusing on? We're not necessarily focusing on, new cash on the sidelines coming in. We did that. That was more of a quantitative easing environment, but now in a quantitative and tightening environment, we have to focus on the principles we used to focus on a little bit more harshly. And, market dynamics like cash on the sidelines is not one of these principles, but one of these principles is price relative to earnings. I'm not just talking about PE ratio. I'm talking about price for future earnings. We can even extrapolate 10 years if you want to. The actual price of the asset you're getting, and the asset is the company, its product, its customers, its team, etc., what it seeks to do, how it's doing it, how it's positioned relative to its peers, etc., etc., etc. Actually buying an asset and trying to own an asset rather than buying something and looking to sell it very short term, get a quick trade, make a quick buck, playing the momentum. These are the kinds of things I don't suggest you do. For example, today the NASDAQ, was looking in the green for a second, came down, was back in the green, then came down 1%. It's a very volatile market, and sure, if you can trade like that, go ahead. If you're successful at it, go ahead. I'm just letting you know, my opinion is that that's a very high risk thing to do. I think there are some stocks that are a little too expensive. I think this period right here has caused a little bit of that to occur. And I'm not saying a lot of these companies aren't going to achieve high valuations in the future, but they're not just going to get there and stop, right? The Fed is actually getting more hawkish this week. Every single member I've heard talk and, get sound bites from whatever, I have been under the impression is getting more hawkish. That's just something to consider because there's a limited supply of investable capital. There's a limited, complaining all you want about the growth of the money supply, still limited in terms of the amount of money that gets put towards investments. We've been in an environment where bond yields have been incredibly low. So people like me, my clients, we're not really considering bond yields because there are stocks that we like that pay dividends higher than bond yields. So we'd definitely just rather buy the stock. But bond yields are making quite a rapid move up. And particularly in the last 2 weeks, and the stock market is just not reacting to that. That, I think, might have been a little bit more than anticipated. So yes, last week was great. Yes, this week was great, okay? Let me clarify once again. I'm basically all in. I've got about a 5% cash position. I've got one single short that's like 2.5% in my portfolio, and it's WeWork, and it's a growth stock because I have so many other growth stocks that are, in multiple instances, twice the size of that WeWork short, just 2.5%, roughly. You know, I am long, is what I'm trying to say. So I'm not trying to be a party pooper. I just advise you and would recommend that you focus on price above all. Have an asset that you think is well priced, okay? An asset that is well priced, a stock that is well priced for its relatively long-term time horizon, because that's kind of the environment you got to be in. We've had this run. My point here is this run is parallel to the run we experienced over the last 2 years. Very similar trajectories, very similar kind of move. And I think we're in a different market. Do I think the market is incredibly expensive here? Not incredibly expensive here, but it's kind of expensive. I mean, it's just had a tremendous run, and there are stocks that are expensive. So I don't expect this kind of run to be a regular thing or a normal occurrence. I think this was, like I said at the beginning, a vacuum-based bounce, a big-time out of positioning, you know, buy the rumor, sell the news, but the opposite type situation. And I don't think that's sustainable. I think, you know, it's been under 2 weeks. I think we get 3-4 months into this, and the Fed is getting hawkish, and the next inflation reading's hotter, and rates are way higher. And I'm not saying a crash is coming. I don't even know if we're going to get to new lows. But what I feel relatively convicted about is that we're not necessarily going to get to new highs anytime soon. And the market's acting like we're going to new highs. So I'm anticipating a more flat market, a little bit more divergence. I think there's still a little bit more churn to work out in the market. Stocks that are a little too high, they need to come down. Stocks that are down too much, they need to come back up a little bit, still have a little more juice in those tanks. So that's how I'm thinking about things. Ultimately, I'm focusing on companies that I think are well priced. I'm buying them, I'm holding them, and I'm enjoying owning these assets. And really, I'm not trying to say the market's going one way or the other here. I'm not playing the market, okay? I have one SPY put option that's decently out of the money with plenty of time that I have as a hedge in case something goes wrong, okay? That's a possibility that can occur. But I don't have a tremendous cash position. I'm mostly long, and I have a hedge, okay? I'm playing multiple different situations, and we'll see what happens. I just don't think the market is going to move this trajectory. And I think that might be some amount of common sense in that. And I hope that makes sense to you. Feel free to ask any questions. I'm happy to answer them. So that's today's video. And until next time, peace out.